All right, everything looking good. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on October 16th, 2022. And as always, before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so let's go ahead and jump right in. Had a little bit of volatility in some crypto last few hours, a little up, a little down. We'll see what happens there. We have some potential of confirming some short-time bullish stuff. We'll take a look at that. Hard to trust it over the weekend, obviously. So here we have TNX to get started with. We did confirm that hard buy signal on the daily. Still all green histograms, blue slope line above both the 8 and 21. We continue to close above the key fib level, consolidate, and then we pushed up and closed at a new cycle high. So as far as I'm concerned, obviously, as long as we're making new cycle highs or new all-time highs on an asset, it's important to pay attention to potential areas where it might stall out, but the trend is clearly up and there's very little recent resistance that would stop this from continuing higher. And we know what that means. As long as yields are going higher, it's very difficult for risk on assets to also go higher. Next, we have U.S. oil. So we had a nice descending channel, get the break of the channel, the move up to retest the 200 exponential. We are still a little ways off of the 200 simple. Possibility we could get a little bit of a move higher to retest that as well. I wouldn't count on it at this point in time as we have closed underneath the 8 and 21. Looks like we got a little back test, but wherever this does stop, we'll look for a pivot. And then if it is a higher low, then we can start looking back to the 200 simple. But typically when we move up and test a resistance, we'll come back down and test a support. And then obviously we're looking for one or the other to hold or break accordingly. We do have blue slope line on the TDMACD. We have the Stokes are angled to the downside and have left the bullish control zone though. So there's definitely a possibility that we have run out of steam on this back test and that we are in fact going lower. That's of course my base case scenario. So Dow Jones. So we had that big pump up. Everyone got excited after the gap down. And where did we really end back up at? That's the most important thing. We've been talking about, are these moves happening? Are these moves sticky? You know, are we just trading in a range? And the truth is, the moves are happening. They're not sticky, and we're still trading in the range. So when we look here at the resistance, we did not put in a higher high. We look here at the support. We did not put in a lower low. So essentially, the range is still our low right here and our high right here. Until we take one of those out, it's really an inconsequential move, to tell you the truth. And while we're consolidating sideways in a range, which is what we're doing, we have basically 2 times we touch the same low and 2 times we touch the same high. Let's look at our indicator oscillators and see what they're doing while price action goes sideways. And what they're doing is they're trending up. And we know what that is. When the indicators and oscillators are moving to the upside, but the price action is not, we see a divergence in the market. And typically what happens in a divergence scenario is eventually one of those things will run out of steam. So if the oscillators are trending in a direction, up or down, while the price action is going sideways, typically once the oscillators trend far enough and then they max out, they roll over and then we see the break. So if we're going sideways on price action, but the oscillators are trending up bullishly, it tells us that eventually when they flip back to bearish, which they obviously will because the market breathes in, it breathes out, typically what will happen is after going sideways while we're bullish, we'll then go down once the oscillators flip bearish. And that's what it looks like is going to happen here on the Dow Jones. S&P, same type scenario. When we look at it really, sure, we gap down, then we pumped all the way up, then we closed all the way back down. And again, where are we at? Well, I mean, if you just wipe out these 2 days worth of price action, the market didn't move at all. So everybody's like, oh, it was a massive day, you know, in markets, they pumped 3%, 4%, whatever. And it's like, well, I mean, where are we at compared to like, you know, 2 days ago? Oh, we're exactly the same. So really, it just sounds like a bunch of people got squeezed to the short side and they got squeezed to the long side. And now we're exactly back where we were. So basically a bunch of chumps got squeezed out of the market and the market's exactly where it was before we started. So there's no new information, in my opinion. The only difference is now there's less people participating in the market that, you know, were unsavvy. You know, if you get squeezed out of a position before the move happens, you obviously made a poor decision, because likely your stop loss was in an easily, you know, accessible position for liquidity. So the truth is, what really happened, the breakdown of it, you know, just full transparency, we closed at the bottom of the range in the last couple of days. So we're at the lowest lows we've been at in literally years. And we're constantly putting in lower highs and lower lows. And we're at the lowest lows we've been at. And then while we're down at the lowest lows we've been at, we had a break to the downside, which then pumped back up, an equidistant move back to the upside. And then we sold off the following day back to the downside. And we're back at those lowest lows again. Now, technically, we're not at the lowest low because we gapped down. But essentially, we're at the lowest low. Take the green candle out of the picture, take the red candle, whatever. I mean, we're still at the same place. So, in my opinion, this doesn't change absolutely anything. It changes absolutely nothing at all. I mean, the fact that we broke to a new low, sure, it's like, oh, we broke to a new low, but it wasn't sticky. You know, we pumped right back up off that low. And it's like, okay, well, we just pumped 3 or 4%. That's huge, right? And you're like, well, where are we at now compared to that? Oh, we're right back where we were the day before. So, in my opinion, nothing has changed. There's no new information. There's no new price action. The only thing that happened is the bulls used a bunch of energy to stay exactly where we're at. That is not a good thing. That is bearish for sure. And just to look at the longer time frames, we talked about these weekly closes. Is that a good weekly close? We basically had a, you know, powerful move to the upside the week before last. We got a clear rejection. We couldn't reclaim the 200 exponential. And now here we see a clear rejection back down to close at the lows once again. All red histograms, hard sell signal. There's absolutely nothing bullish about what is taking place in these markets right now. You know, I know that people want to sell hope or fear. I know it's so much easier to sell those things. And I know people don't want to hear the truth. But the truth is, nothing has changed. Absolutely nothing has changed. We're still closing new lower lows. And when we look at the monthly chart, we're at the lowest low. I mean, this was our monthly close last month. So if we just stay right here, we're just closing at the lows again. If we pump up off the lows a little bit, it's like, okay, thank God we didn't close at the new lowest low candle. If we go any lower, we close a new lowest low candle. So, I mean, in order to even start building a bull case, the market has to start. I mean, we have to see further developments. There's no new information that gives us any bullish scenario right now. If anything, on the monthly, we have the 821 cross. Terrible. That's on the monthly. That's terrible. It almost always leads to a powerful move to the downside, often which stops around the 200s. We have red slope line. We have all red histograms. We're below the zero line. We have a hard sell signal. We left the bullish control zone. Stochs are powerfully angled to the downside. We're very close to entering into the bearish control zone. Not good. Not good. Now, what could happen? What would happen? What would be a sign for a potential bounce? Where would be an area we would bounce from? Well, looking at the SPY on the monthly, if we go from the low right here to the high right here and we put our fib in place, we see we're at the 382 right now. So if we were going to bounce from an area, this is it. So this is where we're looking to bounce from. Now, is that what's taking place right now? Yeah, probably. So what we need to find out, though, is are we going to bounce all the way back up to 236, the 821 cross, and retest that like 399 level, 400? Or are we already closed right here. We're trying to pump back up. It's getting rejected. And we're actually going to go lower. Retest the pre-Rona highs seems very likely. And the 0.5 Charles Dow theory retracement level from the low to high, 50%, seems very likely. So we're at 357 now. Target to the upside is 400. Target to the downside is 324, let's say. You know, we're in a bear trend, obviously. Seems more likely we're headed to the downside. So 324, that's the area I'm looking for a buying opportunity. We need to hold this area. If not, we go to 324. If we do hold this area, it's possible we start to get that move back up and a push towards 400. No signs of any push just yet, though. We do see a little bit of bullish divergence on the shorter time frames. Would have been nice to see a second green histogram, but obviously that was not the case. So you have to look for shorter term time frames and see how it develops. But again, we're at clear support. Very, very technical clear support on the S&P. So we don't want to get too bearish at this level. But we know if this level breaks, we can expect, you know, another quick 10% down. You know, AKA the trap door. And it could be a lot more than 10%. I was going to say it could be less, but probably just, we'll just count on 10%. Triple Qs, putting in new lows at the 0.5 already. So the same way we were talking about, if we lose the 382, we head to the 0.5. For the Qs, if we lose the 0.5, we head to the 618. And the same way we were talking about the 2020 pre-Rona highs for our support level at that 618, we have here the it's the February 2020 highs here at 234, which is the 618. So very interesting to see how these various levels correspond. That's what we're going to be looking for, is basically a retest of that February high back here on the Qs, 618 and roughly 234. And then same type scenario. If we hold the 0.5, we likely get a test back to the 382, about 290. If we break the 0.5, we head to that 618, about 233. So, essentially when we're at one fib level and we're looking at one up or one down, we know what that means. It's basically a coin toss. I mean, obviously percentage up, percentage down is not always going to be the same, but essentially it's around the same, or at least close enough to where we know it's going to end up being like a 1-to-1 risk reward ratio. So right now it's basically a coin toss. We're at support. If support holds, we likely get a tradable bounce to the upside on these assets. If it does not, we likely go down to that next key fib level. And in many cases, it's the 2020 pre-pandemic highs. Not the case on the IWM, as we're already there. Not to mention we didn't make highs from the 2020 to 2018. So we'll look here for essentially hanging out at the 382. We'll look for that same 0.5 level. Obviously, all these fibs are just drawn from lows to high. We look at the XLE, came back up so far, lower high, pretty bearish candle right there. If this area holds, we put in a higher low. Eventually, we could potentially take out that high. But right now, this just looks like a neutral consolidation in a bullish pattern, which has a neutral favor to it. We have a high, we have a low, we have a lower high, then we have a higher low. Then we have another lower high. Likely we come down here, put in another higher low. Eventually we break in a direction, and statistically that direction is favored to be to the upside. Not necessarily my base case. As you know, I'm very bullish on energy long term, but not so much short term. XTN transportation, obviously very important. We lost the 236 in blue. We lost the 382 in green, and we're still trading inside of this descending, broadening wedge. Not necessarily good. We are towards the bottom of the range. Again, we see, even though some of these assets are broken down from some key support levels, it's worth noting that there's potential with this many assets at support around the same time. There is potential for that kind of like reaction rally where there's just not really any sellers left. I'm not saying ever again, but for the time being, selling is becoming exhausted. We're seeing bullish divergence on quite a few assets. We're seeing potential for a short-term tradable bottom. And when I say a tradable bottom, if it's 8%, it's probably not worth it. If it's 10, 15, 20, as long as we can find some nice risk reward trading against the trend. Obviously, most of these assets are bearish, but a nice bullish 20% trade in a couple of days is, well, you already know. It's great. It's great. So SMH, semiconductors, hanging out at the 0.5. Again, very bullish candle followed by a very bearish candle. When we look at the grand scope of things, does this bullish candle or bearish candle change anything? No, we're at the 50% retracement for the entire leg up. Again, at some key support levels here, starting to see some potential bullish signs of divergence, or AKA, code for seller exhaustion. XLU, pretty violent sell-off. This is one I'd be really, really careful with because in my opinion, the trap door has already sprung on this one. Many of the others are waiting, but something about the utilities, for whatever reason, just let go. Well, we know what the reason was. Technically, the reason was we broke down from a key channel support. But fundamentally, I don't know what the reason is. Seems like there's always some kind of narrative afterwards. I haven't heard this one yet. Probably just because nobody pays attention to utilities, so they didn't invent a narrative yet. But the truth is, who cares really? XLP, consumer staples. So again, broke down, found support at the 382, pushed back up, got rejected at the horizontal channel, and now what was support is now acting as resistance for the second time in a row. And then we're selling back off. We have the 382 in green right here. This was our key support level. Ideally, XLP gets a little pushback down slightly lower to about 65, and then we can load up for this potential long. Nothing crazy, but it's still a 5-to-1 risk reward ratio, so potentially worth trading. All right, so let's keep on ripping through here. So we got DXY next. Again, we're consolidating at resistance. We're still above all of our major moving averages. We have a hard buy signal. We still have momentum in our favor. Still looks very, very bullish to me. Tesla is next. TSLA. Congratulations to everyone in the short. Some people have taken profits here already at the green 236. No doubt that's why we got that dead cat bounce. We did put in a lower low though, which tells us we're likely headed down to the next support level, which of course is the trade setup target, the blue 236. And when we get a reaction rally or people taking profits on their shorts off of the blue 236, we likely come back up to the green 236, which is basically where we're at right now. People will likely reload their shorts if that resistance acts as such. And then we'll potentially head down here to the green 382, which is the target of the measured move of the flagpole, the lead in from 138 bucks roughly. Is where we'd be looking at. And, obviously slinky theory along the way just steps on down. Microsoft, again, just basically at the lowest low of the cycle. Still looks very, very bearish. Potential for some bullish divergence to start building. Apple short is still active, halfway there already. We obviously took some profits at the 17% level, looking for the trade setup to play out, and about another 15% or so down to the $116 range. Obviously our 382 target and some key support here from along the range. That's also our descending broadening wedge. I'm not going to get greedy and play this thing to the penny though. If and when we do get another violent break or a couple days down, I would be looking to take my profits sooner than later. For me, a short position should always feel like a ticking time bomb. There should always feel like there's a lit fuse on that position, and you should be looking to get out of it at the first opportunity possible. It doesn't mean you want to exit your trades early. It just means that you always want to be thinking about when it's time to exit. I don't feel the same way about a long position or, a investment or something like that. But the truth is, you're always on the wrong side of an asymmetric trade. You can only ever go to the downside 99 or 100% when your asset goes to zero, but you can always have that potential, especially the lower in nominal value an asset goes to. If it's $100, it can still go down $99 to $1. If it's $1, it can only go down 99 cents to a penny, etc. So the cheaper in price nominal terms an asset gets, the less I want to be short that asset. Because if all of a sudden it suddenly has a pump, if it goes all the way down to a penny and then suddenly has a pump up to 10 cents, it just 10x. There's never a possibility for me to short an asset and 10x my position without using leverage, which I could be using to the long side. Therefore, potential benefit is always, always better to the long side. And that's why we look at trade setup specifically. Otherwise, you would just never go short because it would just never make sense. But obviously, that's not the case. So Google has broken down. We've been consolidating at the 382, attempting to see, is it going to act as support? Is it going to act as resistance? Seems more likely than not that we're in fact just going to continue our next leg to the downside. We're obviously in the middle of our first leg. We had our consolidation, an ABC pattern, a flagpole, a consolidation, and then a follow up with another, potentially equal distant move flagpole. So we have the 0.5 as our next target at 87, potential target down here at 76. Meta is next, on its way to zero. It is definitely winning the race of the major players. Nothing even close to as terrible as Meta is, but it is down here at the target level. We've been looking out for this 382 level for some time. We obviously broke down from the 236. We broke down from the ascending broadening wedge support, and then since then, obviously we had a clear target at the 786. Backtest rejection at the 236 macro, and now here we are potentially, a couple pennies off of the 382. You would think this is going to act as a strong support, at least for the time being. Now, am I just ready to jump back in and go long on Meta? No, typically what I like to do is, if you're invested in indexes and Meta is obviously trash, you just can hedge your worst position in the index by shorting Meta or something to the equivalent and then removing that short or potentially something along those lines. I'm not looking to go out and buy Meta stock necessarily. But that being said, it doesn't mean we can't trade it on occasion. And there's definitely some serious potential for a bounce in Meta. Now, keep in mind, it's a garbage stock and it's probably going to go to zero, but it's going to take some time to get there and it's going to bounce along the way. And the truth is, somewhere down here around 125, the likely area we bounce to, you know, since we just reversed this whole entire trend. So we had this whole big move to the upside, and now we gave back that entire move, and we're back down here. So now we don't need this fib anymore, except for a potential, well, let's just get rid of it. Let's not complicate anything. We don't need that fib anymore. So we now are paying attention to primarily, or, you know, really only our fib, which is like Meta's entire life cycle, because that was a clear swing right there. The next clear swing we have is right here, and then we have one right below that. You could arguably say, well, what about this one? We did this in a prior video to see where, you know, these fib levels lined up, and I wouldn't disagree with you. You could definitely say that that's how it should be. And if you say that, I'm going to tell you why I agree with you, but also why I'm not drawing my chart that way. Because now, if we look at it this way and we say, okay, actually, this is probably a second swing or a different swing level, then really what should we be doing? Well, actually, if that is the case, what we should actually be doing is saying like this. Okay, well, this is probably a 1 right here. And then that is the 2, the retracement of the 1. And then this was actually probably the 3. And then, you know, was this the retracement of the 3? Or, you know, is this the 3 right here? And then we're just about to retrace the 4. So that has to be your go-to scenario if you think that's the case. Because if you think that, I don't think I said that very well. If this is really the 3 right here, and that's the 4, then this would be the 5. And then now we're potentially retracing the entire 5 waves, which is why we have to draw the fib from the bottom there. If we were going to draw the fib from right here, ignore that. Just pretend that's still in the same spot and I didn't touch it. Oh my gosh. All right, there we go. So if you think that that was actually the 1, which it likely was, or you don't care what that was, and you're just looking at this and saying, okay, I think this is just one big wave up here, and like we're now in the middle of the 4 maybe, and then the 5 is still to come, that's potentially viable. But you have to look at it as, well, then we would be fibbing from here to the top. That's the only scenario where we're fibbing from here to the top, is if we think this is the 3 and the 3 is done and we're in the middle of the 4 and then there's going to be a 5, which is viable. But I think the other way is actually more viable. I think it's more likely, and we can keep an eye on it the whole time. I think it's more likely that this is the scenario. That actually we did a little 1-2 right here. We got a 3 up right there. We had a super shallow retrace. Like this is probably like a 618 retrace or something like that, maybe a 0.5. And then from here to here is probably like a super shallow, maybe like a 236 retrace. I mean, I guess we have these tools, we could check. Yeah, that's exactly at a 618 retrace. So that makes sense that that would be its own wave. And then from the 2, bottom of the 2 to the top of the 3, that's basically a perfect 236, which is literally the most shallow retrace that you could potentially have for a Fibonacci. At which point in time you put in the 0.5, and then we see what the 0.5 retrace is from the bottom of the 4 to the top of the 5. And at some point in time along the way, probably this gap down right here, I don't know, actually it was probably the break right here. This was still the potential that, okay, we're just going to retrace this 5th wave right here and go up. So we broke down from a 236 with that gap down, and then we just melted straight down to the 618. And that's like, okay, needs to hold for us to keep going to the upside. Otherwise, we're in trouble. And then as soon as we come up here, we break down from a 618 and start going lower. That tells people, okay, we're no longer just retracing the 5th wave. So it doesn't mean that wasn't just the 5th wave. More likely than not, what's happening now is we're retracing the 5 waves. So now that we're retracing the 5 waves, we look at the macro Bitcoin picture, the macro Fibonacci picture, similar to what's happening in Bitcoin. This being, you know, the first 4-year bull run and retracement. This being the 2018, you know, high right here, basically, or next bull run and retracement. And then this being the most recent 4-year cycle bull run and retracement, you know, 70,000 high. And now we're coming down here. We broke down below the 20,000 previous high right here, or that's kind of where we're at right now. Eventually, if we break down lower, it's going to be very clear we're not retracing just that 5th wave anymore. We're retracing Bitcoin's entire life cycle. And you're like, this isn't Bitcoin, this is Meta. What the fuck are you talking about? I'm just making a parallel between the psychology of what happens as price action develops, and this is what I expect to happen in Bitcoin. So now, once we lose this level, if and when we lose this level on Meta, which I don't think is going to happen right now, I think this area right here is going to act as some very strong support. And actually, oftentimes what will happen is we'll back test the previous fib, so the 236. So that's where that potential for, assuming we get some kind of rally in the markets. I mean, if everything just melts down and goes straight to zero, obviously Meta, the trashiest garbage, most useless trash company that's like toxic poison on society, is probably not going to do the best on a trade setup. But 46% with an 8% stop loss, if we go much lower than 382, we violate these levels. We don't want to be in the trade anymore because we're likely going to the 0.5. So 8% stop loss roughly. Back test of the 236, clear resistance, was support, acted as resistance after we lost it. That would be our back test level, and that's at 183. So we enter a position around 126.75, target of 183.75, stop loss below 115.38 for a potential 47% upside. We risk 8% to have a crack at that upside. You got to swing, to hit a home run. And the risk reward ratio is 5.66%. So 5 times the reward as we're paying in risk. So if I flipped a coin with you and I said call heads or tails right now, okay, and I'll give you $5 if you call it right and 66 cents, but you have to give me $1 if you're wrong, would you take that coin flip? Would you take it 1 time? Would you take it 3 times? Would you take it 1,000 times? You take as many times as you can get it. And that's the beauty of, if you know the probability is 50-50, like with a coin toss, up or down, and the risk reward is 5 to 1, or 5.66 in this case, to 1, you can take that coin toss as many times as you want. You don't go all in on the first coin toss because you could still be wrong. You don't go all in and say, oh, I'm going to take my $1 and I'm going to turn it into 5 right off the bat. Or I guess you would probably have more than $1. I mean, you probably shouldn't gamble if you only have $1. You should just, maybe buy some food because you're probably struggling. But you get my point. So, yeah. So even though Meta is complete trash, there's definitely some potential for a pretty good rally. Now, would I expect Meta to underperform on this rally and just completely shit the bed? And, yeah, probably. But, hey, you know what? It is what it is. You never know when one of these, trash stocks is going to rally. Or cryptos or whatever. On to Amazon. So Amazon had a rather bearish engulfing candle, or no, not quite well, yeah, it engulfed it. Bearish engulfing candle. So we actually gapped up a little bit and then we sold all the way down. But I was just going to say it was a rather bearish looking candle compared to most things, but it's actually a lot more bearish. Most things pumped up and then gave back half the pump and ended up exactly where they were at. Amazon gapped down, pumped up, and then gapped up and pumped down and bearishly engulfed. So now it's in an even worse position. But we did say, obviously, once we lost the 618, that clearly the next target was going to be our 102 level. And, we're almost there now. So once we do get down there, though, that is a strong support. Obviously, though, we have a bunch of steps along the way down. So we just follow Slinky theory, and it just leads us one step after another until Amazon gets all the way to 0. Obviously, Amazon is not going to 0. Gold XAU still looks terrible. Nothing has changed on gold for me, guys. We're just a couple bucks off of the cycle lows, and it seems very, very likely we're headed down just below 1600 to hit that clear Fibonacci target. When we do get there, though, I would expect some kind of bounce from this level. I don't know. I mean, I can't explain it. Gold has performed fairly well early on. I think it priced in a lot of the inflation of the money supply. Gold pumped up about 40%. The truth is, gold is an inflation hedge. So you could either say it's not working as an inflation hedge, which I would disagree with because what I just said, or you could say that we're not likely to have sustained inflation going like years or decades into the future, which I don't disagree with. So gold is saying right now, hey, there's probably a recession around the corner. A global recession, and gold's probably going to reprice accordingly. So look for the first high 1500s, then low 1500s, then chewing on down until we get to probably somewhere around the high 13s. Now, could it reverse anytime before then? For sure. And you know what? We're going to see it happen in real time, so we don't have to worry about missing it. So silver, again, silver just looking brutal right here. Lost key levels. We broke out of the descending channel. Failed to get the measure move, rejected off the 200 moving averages, and then came back down, put in a lower low right here, lost the ascending support, lost the breakout, what was resistance that should have acted as support, and is basically back down here at the lows again. You guys know there's some steps along the way, but I do expect silver at $12. And you're like, $12? What are you saying? And to which I would respond, if the truth hurts that bad, this is probably not the channel for you. But I don't have to tell you because you're probably already gone. So GSG next, again, looking very weak right here, consistently putting in lower highs and lower lows, fighting to save the 200 moving averages right now. Not a good sign right here. Likely going lower as the indicators here are starting to show a little bit of exhaustion. We still have the trend in our favor. You don't want to give up on this just yet, but not looking great. We see LNG pumped up to that new high, had that pretty bearish candle right there, not quite bearishly engulfing. Is that going to be a throwover? Is that the macro top? Is the Wyckoff distribution completed? Still a little early to say that. I don't think it's crazy to think that we're putting in a megaphone pattern right here. That's what I'm looking at. So we're basically selling highs at this point in time, and then we are buying lows right here. So if we do get that pushback down to the lows of our little megaphone, we're looking to buy the 200s, 200 exponential and simple, at least on the back test. Not to mention, we obviously have some clear horizontals here as well, depending on how you look at them. If you look at the cluster where all 3 points touch, or if you want to drag it up a little bit and just go by the tips of these 2 points, either one acceptable. I personally like this level. When we come down here, we'll likely see some support around here, probably a back test and failure, and then we'll get the push lower, and I think that will be the better buying opportunity. But we did see some bearish divergence show up here, 3 drives in a row, and that typically will follow up with some weakness. So paying attention to that, looking for something between 140 and 149 on LNG. MOS, Mosaic. So looking at that fertilizer, so this is a key level obviously we're holding on to for right now. We do have a high, a low, a lower high. What we're paying attention to see is, do we put in a lower low? So a breakdown below that $43 range likely leads us into the low 30s. And that is probably what's going to happen at this point in time. We're very, very close to taking out that low. The alternative scenario is we find support very, very soon, and then we push back up here and threaten this previous high. We'll have to see. I'm definitely looking to get back into this one. The last position played out nicely, but we'll have to see. This isn't a great area to short from. Obviously, not a great area to long from either. So we really just got to see how this one develops. Definitely has some potential for. There's a lot of nice setups for bullish moves to the upside, but you have to trust right now some of this bearish momentum. Don't want to get overly bullish because we're seeing some signs of exhaustion or key levels of support. So URNM, the Sprott Uranium Miner ETF. So we have pretty clear head and shoulders here. Rejection off that 236. Seems like we're getting ready to break down through the neckline. Target down here at about $50. You guys know I'm macro very, very bullish on uranium. I think we'll get a bounce about 50. Probably a back test to around the same level we're at right now, about 62. Should be a nice little, 20% pump back up. And then after that, there's potential we hit this 0.5 back here at about 40. I don't know where uranium is going to find strength. This is the worst one to chart for longevity. But likely what happens is we likely put in a macro bottom sometime above this one. Now, it doesn't have to happen. We could come down here to these 20s or whatever. Again, this is not the best chart to use right here. It's trading very technically, but doesn't have a lot of history. We'll see how low these uranium stocks are going to go. Macro, very, very bullish on them, but it's not crazy to think they could have like 2 or 3 years of downside potential. A lot of people came into the uranium game and got really excited at it after the run was essentially over, at least the first leg of it. So, I know people don't like to hear it, but, it's okay to be right. But if you don't have the right time horizon, you're still wrong. If you tell somebody, hey, if you invest in this, you're going to 10x your money, they will, of course, invest in it. And then if you say, if you invest in this, you'll 10x your money in 10 years, then maybe they'll invest in it. And then if you say, hey, if you invest in this, you'll 10x your money in 10 years, but first you're going to lose 50%. Some people are not going to invest in it at all. Some people are going to try to time it. Some people are going to sell when they're down 50%. Got to be real careful. That's the thing about, being right, and then also having to worry about timing, which is why I'm not a huge fan of options. You can trade. All you have to do is be right. It can either go up, down, or sideways. That's it. There's not a lot to it. If you start betting on options as well, you're now saying it's going to go up or down, and it's going to go up or down in a certain amount of time, or it's going to go sideways in a certain amount of time, and it's just exponentially more difficult, in my opinion. Now, some people I know kill it at options, but it's the difference between, can you consistently kill it at options, or are you just doing really well sometimes because you're using a ton of leverage? And I mean, I'm not hating. There's no problem with using options. It's perfectly fine as long as you're using them responsibly. If you're using them to just use 100x leverage on positions and you're betting all or nothing, that's completely fine as long as you understand that's what you're doing. And if you're using options for anything other than, hedges, that's probably what you're doing. So CCJ, Cameco, obviously got back in line with where all the rest of the uranium stocks were. We did see some divergence on Cameco. It was basically showing its ass, trying to act like it was more bullish than it is, and now we have broken down from key levels. Still is technically okay as long as it holds this white support level. And you know what? We took profits up here on Cameco at about $29, and now it is down at about 21. And somebody was asking me about, essentially, it's not easy to just buy something low and sell it high, and then it's even harder to know when to get back in. So the truth is, if you already have step 1 and 2 done, you bought something low, and then you sold it when it was higher than it was when you bought it. So you made a profit. You locked in your gains. You already did great. But everybody acts like that's the end of the story, and that's it. And then just, we live happily ever after. But the next question is, if that's something that you want to be positioned in, say you wanted that position, you like that. You like being invested in Cameco. You like uranium. You like the future. But you want to lock in some gains. How do you know when to get back in? And the truth is, that's up to you. You have to decide for yourself when to get back in. So you need to have some sort of indication as to what your trigger is to enter a trade, the same way you have a, trigger to exit a trade, etc. And if you don't have something like that, you should, start to derive your own system, or you can steal someone else's, or borrow someone else's, or just use someone else's like mine. Obviously put that out there for free. But the truth is, if you bought, let's say you bought at $20 and then it ran up to $30 and you sold, roughly. Now it's back at $20 again. Do you just automatically buy because you locked in gains and you could just reopen your position or buy more of the position at the same price? That's perfectly acceptable. There's nothing wrong with that. And then what if it goes lower? Well, who cares? You already locked in gains. So, you're fine. And you want that position and you're expecting it to eventually go higher. The threat is that you enter too soon and it continues to go lower, and then you took a gain and then eventually you sell and you take a loss, and then you turn what was a winner into rushing back into that same asset, and now it turned into a loser or neutral. That's the risk. The other risk is that it pumps back up, it continues to go to the upside, and then you never buy back in because you're reluctant to buy back at a higher price, or thinking you'll buy the next dip and then it just never dips. So figure out what you're going to do in advance, figure out your own system, and you'll be much better off in the future. A lot of times people talk about it like it's, buy low, sell high, and it's over, the end. Congratulations, you did it. But the truth is, it's much more complicated than that. Likely, if you were speculating or investing in an asset to begin with, it's because you believe in that asset. Therefore, at some point in time, you want your position back. So if your position is when it goes back to your same entry price, when it goes back to the 200 moving averages, when it goes back into a bull trend, whatever your situation is. For me, I don't want to hold assets when they're not in a bull market. So for me right now, Cameco's clearly in a bull market, and it's getting ready to what looks like flip into a bear market. Taking out this low is a big fucking deal. So if we come back up here, we start to get bullish again. We see momentum building on daily, weekly, monthly timeframes, etc. I will look to get back in this position. But even though we're back at that $20 level, where we took some of the recent scalps, I'm not looking to get back in right now because we're likely confirming into a bull market, or bear market, I'm sorry. Here, when we're in this bear market, it's okay to scalp. You could scalp this move, or you could scalp this move or something like that. But the truth is, you don't want to be holding in the drawdown. So the same way here, when we break through the 200s, and we come back down, I often sell into the 200s when we get back to them, and then, or I'm sorry, sell into the pump, expecting that we will backtest the 200s, and then I'll buy, because now I say, okay, it looks like we're flipping into a bull trend. If I'm wrong, we break down through these levels, I get stopped out, and we continue to go lower. If I'm right, we likely go into a big bull trend, and I end up in a very profitable position. So if we're about to potentially go into that bear trend right now, I would want to be short, or betting against Cameco. Well, I don't want to short Cameco. So rather than just holding Cameco because I'm a bullish speculator and it's a company and a space that I believe in, I'm just going net short essentially, or net flat or whatever, by selling my open positions in Cameco. And then that way, I'm not just hodling an entire downturn that lasts for 1 or 3 or, based on uranium's past, like 30 years. So Tilray is next. Speaking of things you don't want to just hodl into a downtrend, this is a perfect example. I could have easily not sold my position here on Tilray, thinking that we're going to continue going much higher and put in new all-time highs. And if I would have, I would be upside down on my position. Because you guys know, obviously, we got into Tilray at about like it was like 775 or something like that. And then we rode it up here and sold it near, it was in the like high 30s to 40s. We were taking profits through this area. So had we not taken those profits, we would have actually turned what was an awesome, amazing, winning position into a loser right here. And we've continued to just melt down. And same thing for anybody that was just buying the dip, buying the dip, buying the dip, buying the dip. And now they're out of money. Their wife left them, and, they live with their brother and, ride a bicycle to work. Hypothetically. So you don't want that to happen. The best way to not get wrecked is to take profits. Now, there is potential. Tilray is starting to build up some steam down here. We're starting to see more and more bullish divergence. Starting to feel like some of these pot stocks are definitely running out of sellers. But, again, starting to feel like they're running out of sellers. Does not mean they don't go much lower. So PFIX, we talked about this one last stream. This is just basically a way to hedge interest rates. Now, the problem with this is there's not a bunch of history on this. But essentially, we can just use this as a obviously it's a hedge interest rates. So as the interest rates rise, this does well as well. Also, so essentially it's in a blue sky breakout. So we know when something's in a blue sky breakout, it's good to go. The main thing to look out for is if it breaks down by like the previous high. So as long as it's above 65, it looks good. It's tough to get targets on this just because we don't have a bunch of history like going back into the 80s or anything like that, like we do with interest rates. So there's a couple different ways we can do it. We can use a fib extension, and we could go from basically the start here to the lows right there and see where that goes to. So if we start from right here around like 50, and then we go down to the macro lows at like 37, we can use our fib extensions to give us like targets to the upside. So the next would be like the 2.382 or 2.618, something like that, up in like the high 70s or low 80s. Alternatively, we could use the recent high right here to this low right there, and then that's going to give us a little more like, I guess, like attainable targets to the upside. So we could see, or I guess like relative, or whatever you want to use, whatever random word. So we hit the 1.382, we're back testing the 1.236, likely headed to the 1.5 or the 1.618. So I think likely we're headed up here to around like 75 to 78, and then we'll kind of see. But the truth is, you really don't even need to do like technical analysis on this chart specifically as much as you can just do technical analysis on like the interest rates and just kind of go from there. So if you're looking at like the 2 or the 10 or something like that, you're probably going to get a pretty realistic idea of what's to come on something like this. So, but obviously we see some confluence there, so no reason not to do technical analysis. All right, and then on to our cryptos. So we have Bitcoin. Obviously nothing happening in Bitcoin. It is a completely dead asset, lulling people to sleep. You can tell by the level of interest in cryptos that literally this is a dead asset class, which is fine. That's what we want. But the truth is, oftentimes when the markets are lulling you to sleep, it's because there's a big move coming. And we know, based on Bitcoin, fib levels, based on key support levels and resistance as well, that likely the next move is going to be a big one. Targets a downside of 16,500, 14,000, or 10,000. Target to the upside of 26,000, 28,000, or 32,000. we're going to have a massive move ahead of us one way or the other. Now, if you tell me right now, hey, are we going to go up or down, and you have to like bet with your money, which one is it going to be? Well, I mean, I'm not buying Bitcoin right now, so I guess I'm betting on lower prices. But I'm also not like openly shorting Bitcoin right now either. So I'm not that confident that we're just going to straight up break down from here. Now, if you ask me a year from now, is Bitcoin higher or lower? Honestly, I couldn't tell you the truth if it's higher or lower either. But if you ask me, do we go lower than our lowest low from here? Or do we go higher from our highest high from here? Which one happens first? Basically, like, do we go over 70K or do we go below 18K? I would say lower. I think we go lower first. What would change my mind? We would have to build a lot of price action to the upside and have constant back tests, etc. So, I'm just not confident in higher prices from here outside of the range. Now, you guys know we've been inside this channel now for a long time, and we're continually finding support at the bottom of the channel. We traded outside of it a little bit. You could argue, hey, I should just adjust my channel. I like my channel just how it is. You can adjust your channel however you want. But the truth is, we've been inside this channel for months now. Likely that's what's going to happen. We're at the bottom of the channel right now. So if you're a bull, you have to know that the risk reward right now, short term, if we stay inside this trading range, all the reward is to the upside. We could go up another 27% to the top of the channel. That's pretty good, 27%. I mean, that's always nice. Or we could go down 1.2% to the bottom of the channel. So we have a 5 to 1 risk reward ratio. If you believe this channel is going to hold, if you believe we're at support right now, if you believe Bitcoin is going higher from here, there's a 25 to 1 risk reward ratio. Now, I wouldn't use that literally 1% downside stop loss because, likely you get stopped out and then you're right. Just, But there's a reason everybody's not buying right here, expecting that 25x, 25 to 1 risk reward ratio, not 25x, but 25% move or 25 to 1 risk reward ratio. There's a reason nobody's buying this because people don't believe it's going to happen. And the reason people don't believe it's going to happen is because the first time it happened, here we were at the lows and it happened. We did it. We got there. And then the second time people said, well, it's probably going to happen again. And then that time we only got to 22. So less people believed it was going to happen. We got down here. And then people got scared when we broke down here. And then we started pumping and they say, oh, we're doing it again. We're going to 25 again. And then we went even lower. Now we're at 20. Now the gap is only, $1,000, $2,000 right here. So now here we are at the lows again. Nobody's fucking buying. Nobody even thinks it's going to go to 20, let alone 22, let alone 25. So either everybody's going to be wrong and it's going to go to 25 or 28 or, 32 or new all-time highs or whatever. Or trapdoor is going to fall out and, we're going to end up down here in the teens. Well, we're already in the teens, in the much lower teens. So there's a bull case. There's a bear case. Stochastics are pointed to the downside. We're in the neutral zone. Could go either way. A couple green histograms, couple red ones. We're below the zero line. We're above the slope line. The slope is blue. The histograms are mostly red, but there's a couple green ones. We're below the 8 and 21 moving average, but we're close, trying to push up. We're below the 200s. They both have a negative slope. Most everything's still pointing to the downside, but we go sideways here long enough, and, there's potential that we get a bounce. Or trapdoor. Could go either way right now, folks. Honestly. Could go either way. But it feels a lot like that 2018 6K level, right? Where everybody was like, the floor's in, we're putting the floor in, we're not going to go below 20K, this is it. And then next thing you know, we go sideways forever. It's lower high, lower high, lower high, same low, and then finally trapdoor. And, a couple weeks later, we're down 50%. Well, a couple days, shit. So 10K. Ethereum, nothing has happened here. Still holding that channel, which is good. As long as it holds this level, I'm okay with Ethereum. If it goes sideways much longer, again, it doesn't look good, but at least Ethereum has this cushion. If Bitcoin breaks down right now, it's basically testing the lows. Ethereum has this little cushion of $1,300, a nice little 30% cushion, where Bitcoin could break down, Ethereum could break down. Ethereum doesn't have to violate key levels. Bitcoin breaks down, shit's hitting the fan. Ethereum still has that cushion, that sweet spot. Crypto total market cap on the weekly below the 200 simple, and slope is almost flat. Not good at this point in time. Definitely not good. Don't want to see this. We do technically have a low, then a higher low, but it looks like we're getting ready to test that real soon. We're only about 40 billion away, 34 billion away. Not good. Bitcoin dominance. Again, we had an aggressive sell-off and then a nice little pump, and now it is starting to strengthen. Looks like it wants to strengthen. Hard buy signal coming out of the bearish control zone. Multiple green histograms threatening the 0 above the slope line. It is blue above the 8 now, testing the 21. 8 and 21 likely to get a cross soon if we continue to push up here, telling us that people now suddenly are putting money in Bitcoin instead of shitcoins and stablecoins. Could it be Bitcoin is getting ready to have a massive move to the upside? Let's check our other Bitcoin dominance chart, the one without the stablecoins. And we see here that actually probably what's happening is that people are speculating on the dollar with stablecoins. People are speculating on cryptos, but more people are moving their money out of shit cryptos and into Bitcoin. Not necessarily because it's going to go up, but because it's going to go down not as fast. So there's two reasons people want Bitcoin instead of shitcoins. It's because they either think Bitcoin is going to go up faster or Bitcoin is going to go down slower. So when does Bitcoin go up faster than altcoins? Very, very rarely. Very rarely. So likely what's happening right now is people are repositioning for the old trapdoor. But what do I know? I mean, it's not like we're going to just come on one day live suddenly out of nowhere, on a just random, unexpected time slot and be watching in real time as Bitcoin sells off 10, 20, 30, even 50%. That's definitely not going to happen. Not anytime soon. Not this year. Definitely not going to have a random, unexpected live stream with a, 20% sell-off on Bitcoin sometime in the next couple of weeks. Definitely not going to happen. And it won't be titled something like The Trapdoor is Here or Bitcoin's Final Day, The Execution, or, something along those lines. Definitely not going to happen. What's up, Parag? Good to see you. Says, what's happening, everyone? Good stuff. For 401k, how should one structure the portfolio for long run? I have been in cash since buy 41.20. Well, first off, congratulations on ducking the market during this drawdown, my friend. Touche on that one. I mean, I can do and say whatever I want, as can other people, but in the end, it's up to you to make those decisions. And obviously, you made a great decision. As far as structuring it for the long run, I mean, it depends on what your other investments are. I think, honestly, I mean, you should have a blend, obviously, of assets. I'm a big fan of having at least a decent percentage of your portfolio in gold and silver. Whether a decent percentage is 5% or 10% to you, that's your choice. Obviously, none of this is financial advice, but that's like schmuck insurance for me. Something I buy with no intention to ever sell, to one day pass down to my kids. There's no carrying cost for physical gold or silver, and it holds its value on a long time frame over time. But you're not really using it to speculate with. You're using it as protection or insurance. And then after that, look at your other various asset classes. I have a breakdown between, the next way to essentially break it down, or the first way to break it down, is things that pay you. So you want to have, obviously, some portion of your portfolio in dividends, in my opinion. You want to have some real estate potentially that pays you via rents or something like that. If you were just getting started, I would go with something like a duplex, et cetera, et cetera. There's lots of ways to build up. I don't know exactly where you're at or give you specific advice or anything like that, but you want some assets, in my opinion, that pay you to own them. Now, if you're still young and you have a, more aggressive portfolio, perhaps you want to be more into stock market and you're looking for dividends. If you want to be more actively involved, maybe you want to buy some actual, rental properties. If you're looking for, more passive income and safety, with the exception of obviously this outlier year here, perhaps you'd be looking at some bonds. But the truth is, I think you should be diversified in essentially all those things. But the way I basically break down is, okay, does this asset pay me to own it? Yes or no? Does this asset preserve, buying power over long periods of time? Or am I buying this asset speculating that the actual underlying principal or purchase price will go up over time? So then you can break it down from there. For me, a lot of people say you have to be like concentrated or go all in on one thing if you want to get rich, and then you diversify to stay rich. I think it's sort of like not true. I mean, there's definitely cases where that's true, but I think a well-diversified portfolio in intelligent assets and asset classes is the way to go. I mean, but, again, that's just me. And when I say diversified, I don't mean just like diversified within the stock market. Obviously, it's good to have index funds or, various weights in like the different asset classes, etc. Obviously, it makes sense right now for a lot of people, or did make sense this year, to be overweight energy. But when you're overweight something and you're taking profits on it, or, readjusting your portfolio because you're becoming more and more overweight as something overperforms, at some point in time, you have to either bring that back into line, with the normal percentage of your portfolio, etc., or normal weighting of your portfolio. That's up to you, obviously, based on what you think is going to happen. But I mean, if you went like all to cash, if I went all to cash this year, which I went substantially to cash, very large cash positions relative for like stocks and cryptos, I already am at the point where, sometimes I'm thinking, I should really be starting to put some money back into these markets. One thing that I do that helps to like fulfill that urge or stop me from feeling FOMO is when I take scalp positions or trades, like swing trades, shorter term stuff, I'm not expecting to hold as a position. When I take profits out of those positions, I'll oftentimes keep some, we call them like we call it trade dust, but just part of your profits, essentially, just keep them as holdings or whatever. So, say you entered into a, scalp trade on Tesla and you made 20% on your scalp trade or whatever, and say you had 10 shares of Tesla, you might sell those 10 shares of Tesla and take all your profits, your 20%, or you might just say, hey, you know what? I'm actually going to sell 8 shares of Tesla, get my money back out of it, and then I'm going to keep the other 2 and start to build a position with my profits. Or you might want to do something in between. You keep one Tesla, you sell the other one for profits, take all your initial investment back out, you have profits now, and then, you start to build a position. Lots of different ways you can do it. I find that taking profits out is always good. Taking my principal out is a necessity, and then leaving some of the profits in, helping to build those positions. And essentially, you feel comfort in those too. You don't feel like you need to sell or buy those things or manage those positions because it's the market's money. So it's up to you, man. It's super detailed answer. Hopefully that helps you at least give some kind of like perspective or whatever. I know it can be definitely an uneasy feeling. Thinking, oh, what if the market does just start to pump up tomorrow? What if it does start to turn around? And the truth is, we watch this thing every day, obviously in the group and everything, and then we do the live streams every other day or whatever. There's no signs of life out of this market, let alone signs of like reversing or whatever. So I'm not nearly as concerned as buying the bottom or dollar cost averaging into a position as it goes down, as I am just making sure when the momentum shifts, that clear as day, I know what my entry points are. And you've been following the channel for a long time. You know exactly what it is. The daily 8 and 21 cross to the upside. And then we get back above the 200s. And then, we get the multiple green histograms on the TDMACD. And then we cross above the 0 line. And then we're above the slope line. And the slope flips blue. And then we get the stochastics leave the bearish control zone. And then the bearish control zone flips. And we get the hard buy signal. And then the stochastics are powerfully angled to the upside. And then the stochastics enter the bullish control zone. I mean, and as we go, we're just strengthening into momentum. So that's how it is for me. That helps me to sleep well at night. Obviously, the first 5, 10, 20%, you miss out on it, whatever. But the truth is, I would rather miss the first 20% of any move and then know afterwards that we're going to be in a bull market than, by hoping that one day the bottom is in and we're going to flip back into a bull market. Because right now, honestly, man, I'm not the most bearish I've ever been on the markets. That was probably right before the Rona dump. And rightfully so, obviously. I'm not that bearish right now. I'm really not. but also there's no signs that we are bottoming or going to bottom anytime soon. And the danger for downside potential is higher than it's been even then, even pre-Rona, because of all the extra quantitative easing that took place and the amount of quantitative tightening that is taking place currently. So there's an extra long answer to a non-specific question that is definitely not financial advice. But hey, Parag, if you are looking for something in, the meantime, well, I shouldn't even say the meantime. One thing I wouldn't rule out, and I talk trash about things when they look like trash, obviously, but one thing I wouldn't rule out is bonds going into the future. Now, I'm not saying now is a good time to buy bonds, but when they start paying a decent percentage, it starts actually making sense. And, you're looking at like 4% treasury bonds or whatever. Now, the reason nobody's buying bonds right now is they're like, well, they're at 4 now. They could be at 5 in a month or 6 in a month or 7 in a month. And, obviously my base case is Fed funds rate at 5 real soon and then probably 7.2. I don't know when it stops because I don't know when we fix the problem. But the truth is, or when, the tightening catches up to us. But the truth is, 5%, 6%, 7%. That starts looking pretty fucking juicy. And it's not a lot of money, but you can buy something like I bonds right now, essentially inflation adjusted bonds. And, depending if you're married or not, et cetera, I think you can get 10 grand of I bonds, potentially more depending on what you're doing. And they're paying like 9% right now. Now they do adjust the interest rate percent. I think it's, every 6 months? So, potentially it would be lower in the future. But inflation is not just going to be at 1% all of a sudden. And you're like, oh, I bought these things at 9 and now they're at 1. It's not going to be like that. It's going to be like, oh, I bought them at 9 and now they're at 6. Short duration, for a year or something like that, worth paying attention to. But I think the truth is that one day when things stabilize again and bonds are paying something like 5, 6, 7%, zero risk basically, like, treasuries or something like that. And when I say zero risk, I mean, AAA rating. There's going to be some serious potential there. I think a lot of the reason why stocks and cryptos did, I know a lot of the reason stocks and cryptos and real estate did so good for so long is like the whole Tina situation. There is no alternative. If nobody will pay you for your money, you have to take more and more risk. Well, now suddenly, people are paying again. So that means you don't have to take the same amount of risk. So, what's better? Speculating and making 12% or guaranteed making 7%? It depends. A lot of it's on your age. If you are 60 years old, you can't stomach a 20-year bear market. If you're 20, who fucking cares? You pray for a 20-year bear market. Because if you get a 20-year bear market, and you're buying in this massive bear market, you're going to be exponentially better off, 50 years into the future. So a lot of it has to do with your age, your time horizon, how much wealth you're talking about. There's just so many factors to it. But sounds like you're making some good decisions. So I would just keep at that. For sure, brother. For sure. What's up? Neuroman Van Houten. EMA 21 and MA 200 weekly on Bitcoin look like just crossing. Are we going down to 6K from fib ratio? Yeah, good, man. I'm glad you enjoyed that, Prog. A lot of times when I ramble too, I'm just like talking, hoping that you'll get some kind of good idea out of it. So glad that some good info in there. As far as Neuroman, if we look at Bitcoin on the monthly right here, what were you talking about? Are you talking about on the daily? Oh, weekly. I'm sorry. You said weekly. Oh yeah, weekly 200 set. So yeah, the 8 and EMA 21 and MA 200. Yeah, it's worth note that the 21's crossing below the 200. That's not like some crazy huge like line in the sand for me or anything like that. I don't really look at that as anything specifically. Doesn't mean it doesn't mean something. It's just not something that I've found particularly amazing. Like here we averted that cross, which is a big deal. Here we did not. We're getting it. But that basically tells you the same thing with the 200s. Here we averted losing the 200 as support. Here we didn't. Here we lost it. So once we lose the 200 as support, it's just a matter of time before the 21, goes below the 200. So it tells you the same thing. It's just a different way to look at it. I like losing the 200 simple as support because it tells us, you know, this was like months ago. We knew that, as we're just now we're getting the cross. So I don't want to get bearish at the cross when we could have been equally bearish months ago, which we were obviously. So yeah, it's kind of a non-event for me. Doesn't mean it's not useful. It's just sort of like a lagging version of what we already do. So, and then as far as, what did you say? Bitcoin to 6K. 6K is way below. If we do get to 6K, which is not unrealistic, it's not crazy to think we get to 6K. Obviously, I have targets down here and a bear case scenario of 6K. I don't know if you knew that or you were just throwing that number out there. But I wouldn't go like overly bearish and start looking for 6K, because the truth is, you know, that's just from our 3K low to our, you know, 70,000 high or whatever. That's 6K down here is the 786. But realistically, there's a bunch of other levels along the way. The first level I would be paying attention to is essentially, you know, if we break down from 20K, we obviously have that monthly candle and like that 15K level. I'm going to switch over to the monthly because I think it reads a little clearer here. If we look at the monthly right here first, there's a bunch of different things worth paying attention to on the monthly. But when I look at it right off the bat, I say, okay, if we break down from here, we have this one candle holding us up. The next target is 14K, because that's basically this candle. If we lose this candle, we're at 14K. That's also the wick from this candle. That's also the body from these two candles. So for me, the next big level is, there's like some resistance support around 16.5, but the next monthly support key level is 14,000. After that, we have one candle right here, and then these two candles, and then, you know, that basically takes us to 10,000 to 10,800. So that's our next key target for support. So again, 14K, then around 10K, and then after that, we can start looking at, you know, some of these other key fib levels and everything. But it's a ways down for 6K before I would get excited for that. So if we take out 14K and then we get down to 10K, I'll start talking a little more about 6K. But right now, when we're still at 20K, I don't foresee us just having some big 66% sell-off suddenly. It's possible. It's possible. I mean, this is where I think we're at right here. You know, we basically had, and you could argue, well, that's what you said when we were right here. And it was. We were at that flat support right here, and the 8 and 21 were closing up, and it looked like we're getting ready for a trapdoor, and we did. We got that trapdoor exactly as expected. And it was the exact monthly candle right here and everything. Sort of seems like we're doing the same thing. You know, again, you know, obviously we're below the moving averages, but we're just kind of going sideways. Nothing's happening here. And it just looks like we're getting ready for another leg down, which would honestly, you know, just fulfill our target. Because we know realistically it's the 1, it's the 2, it's the 3, it's the 4, and then we're expecting the 5. So the next short-term target is that 15K level. But the truth is really like 10K is what we're looking for. You know, and then afterwards we can start looking at 6K and all that good stuff. But right now, if I talk about 6K, people are just like, you're crazy. But nobody calls me crazy if I talk about 1 million or, you know, $250,000 Bitcoin. No, nobody thinks I'm crazy then because it fits the narrative. All right, we'll go ahead and wrap it up there. Appreciate everybody that tuned in for today's stream, our Sunday evening market look ahead. Yeah, everybody have a good one. It's going to have a good week ahead of us this week. Should see some volatility, lots of excitement. Hopefully, sometime in the near future, we'll break either up or down from these ranges and have some nice scalps. But there's been a little less opportunity lately, but some nice opportunities nonetheless. Obviously, the Tesla trade, the Apple trade, a couple of decent little scalps here and there. But we are obviously looking for the next big trend. And, you know, the truth is, people can only sit on the sidelines for so long. Eventually, something's going to pump. Something's going to get excited. You know, we always give, like, the GameStop people, or what are the other meme stocks? Silver. We give all these, like, meme stocks and meme metals. Like, give the, what are they called? The apes and the, all the donkeys or monkeys, whatever they are. We give all the, all these idiots hell for like crowding into stuff or whatever. But the truth is, the whole market is like looking for the next quote unquote like shit coin or like, you know, meme stock or whatever. Not literally, But like, I mean, isn't Apple really just another meme stock? Like, I mean, sure, they make actual profits and everything, but like everybody piles into Apple even more because it's an index, and then they pile into it because it's like main portion, like because it's in the index, and every time people invest in the index has to buy more Apple, therefore they buy more Apple, and then Apple's buying back Apple, and then Warren Buffett's buying back Apple. So the truth is like, is everybody really just kind of meme stocking it? Yeah, they kind of are. I mean, obviously Apple's a little better than, some shitty movie theater that sucks and, probably should be out of business by now. But it's kind of like the same underlying psychology behind some of it. So right now, I think a lot of people are on the sidelines kind of itching, looking for, okay, something's going to have to trend to the upside soon. What's it going to be? Is it going to be more energy? Is it going to be something different this time? Everybody's looking for it. And the truth is, whatever it is that happens, whatever the next bull market or bull trend or whatever that starts up is, it's going to have a lot of momentum behind it because the breadth of the market is so weak right now that if anything looks good, people will run to it. And that's why energy worked out so great for us. We were already positioned ahead of time for the energy trade. And then by the time everybody else has already been underweight energy for literally years, so by the time everybody else gets excited about energy, we're sitting there counting our money, waiting for people to show up. And then they start showing up and it starts really pumping. And then, obviously we're able to get out essentially at like the absolute top, which again played out beautifully. So it's not always going to work out that way, but I think we got a couple more shakes on the old Magic 8-Ball. So yeah, that's it. We can go ahead and wrap it up there. Appreciate everybody tuning in. Check us out on Wednesday for our midweek market update, and then Friday for our weekly market wrap up. I appreciate each and every one of you guys, all the group members out there. Shout out for making the Friday live streams possible. And everybody have a great week. Obviously, none of this is financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. And of course, that is it for tonight's stream. It is 9:15 p.m. Eastern Standard Time on October 16th, 2022. And I'm Crypto Trend Trader, and I'm out of here. Bye.